Hi, I'm Tim Haunn, founder and president of the Haunn Group, a boutique planning firm in Mississauga that has integrated wealth planning for accomplished entrepreneurs. We're here today with a long-term friend of mine, Trevor Parry of TRP Strategy Group. He's going to provide some insight into succession planning and the current tax environment. Thank you very much, Trevor. Much appreciated.
Thanks, Tim. We want to talk to the folks today about some of the challenges what we're finding in the tax planning world. The ability to hopefully preserve capital, but also to reduce tax wherever possible, to defer tax wherever possible, and to, most importantly, create concrete succession plans that insulate wealth from undue taxation, or in many cases any taxation whatsoever. And of course we always want to do this prudently in a low-risk environment with the blessing of a client's trusted advisors, that is their accountant and lawyer. And we certainly, I believe, have answered that clarion call countless times in the recent period. The new government elected last year poses a significant challenge for entrepreneurs and incorporated professionals in that their tax policy is a departure from the stated tax policies of the three previous governments, so that of Jean Chrétien, Paul Martin, and Stephen Harper. Those governments believed that tax could spur economic activity through the ability of businesses to create capital and wealth, and hopefully that would translate into expanded economic activity and employment. And I think that the statistics bear that out. That's where you saw a radical lowering of the small business tax rate, and certainly the encouragement through various other tax measures of business initiative. We had a fundamental change last year with the election of Justin Trudeau. We see effectively the left wing of the Liberal Party have taken the reins of power, and they're not fools. They understand, and they have a lot of talented advisors. They understand tax very well, and they have a stated goal of raising revenue to cover off their expanded spending plans. I believe that they've departed from any sense of fiscal responsibility, but that's my own opinion. The first significant challenge we saw was on the business side, a freezing of the small business tax level. It was supposed to continue to fall. It's now been frozen indefinitely, and I would garner that we will not see a significant decrease in the life of this government. And then on the income tax personal side, we saw the largest tax increase in recent Canadian history, and now in Ontario, if you are earning in excess of $200,000 a year, you're going to pay 53.51%. In my opinion, they have crossed a moral Rubicon, which is a clarion call to tax strategists like myself to move forward in assisting entrepreneurs in protecting against this very punitive tax environment. There are certainly reasons to fear further tax measures. We have heard trial balloons consistently floated, such as the increase in the inclusion rate on capital gains to 75%, which would create a capital gains tax effectively in Ontario of 40%. That would end, in terms of post-mortem planning, the use of the strategy referred to as pipeline. The other important tax measure that began in the last government, which has certainly gained teeth through both provincial and federal initiatives, is what we call integration. Integration is very straightforward. It's the idea that you should not be able to benefit one way or another based on how you take your income, whether that is dividend or income-based. We have a scenario now right across the country where there is no significant benefit to taking dividends, and in fact most cases favor, if you look at the charts, it will favor income. That's important because it reduces the ability for a lot of entrepreneurs to reduce taxation somewhat. It also has created what I call an integration funnel. The government very much wants as much income to come out just as that from corporations as income. And as a result, we need to step up with prudent strategies that create retirement deductions and enhanced retirement deductions, and also some long-term tax planning measures. I think one thing that we have to look at now is the corporate structure. A lot of individuals have put structures in place and life insurance in place to fund future tax liabilities, and unbeknownst to them have created potentially huge tax liabilities in the event of a share sale where a holding company has not been established correctly. We really favor the use of a structure that focuses on a family trust. That family trust gives the ability of the entrepreneur to create ongoing tax relief through the payment of dividends and the ability to magnify the capital gains exemption to hopefully zero the tax at the time of sale, and also the ability to create what we call beneficiary corporations, which allow us to hold all of the passive assets, most importantly the life insurance, so that those assets are insulated from a potential sale. Advisors, though they have intended clearly the best wishes of their client, often have placed insurance into a holding company which, if you have let it sit for a long time, can give rise to a terrible, almost Wile E. Coyote looking down the railroad tunnel moment in terms of tax inclusion, given the calculation of fair market value associated with the plan. So we need to encourage entrepreneurs to look at their structures, look at their succession plans, particularly in the advent of potentially higher capital gains rate, and look for meaningful, sensible tax relief now and for the future. Thank you very much, and if you have any questions, please contact the Haunn Group, and we'll be glad to get in touch with you. Thanks.